Today, where some Nigerian banks have issued possible dates to exit the Central Bank of Nigeria's regulatory forbearance in respect of single obligor limits and other credit facilities, noting that they will comply with regulatory requirements and position for dividend payouts to shareholders for the 2025 financial year. Nabila Mohammed, the banking sector analyst at Chapel Hill Denham, joins me now to explore how this development is impacting the banking stocks in the Nigerian equities market today. Thank you so much for your time today, Nabila. And let me first get your take on what we've seen play out here. Several tier 1 banks have come to more or less signal their exit from the forbearance. And what does this say about the asset quality in the banking system here in Nigeria and also the risk management outlook?
So really what this forbearance, exiting the forbearance is, I could describe it as a short-term pain for long-term gain. And the CBN, that's the central bank that issued this particular circular, is well aware of the fact that these banks have become more profitable. They're raising capital that would serve as buffers for them in terms of absorbing whatever shocks that would happen most likely. So they believe that they believe that this is the right time rather for them to issue this circular. And what now are the implications of all this? Number one, the forbearance was gotten as part of a relief in 2020 when COVID happened and it was difficult for some of these borrowers to go and service their obligations basically. And the banks, on the other hand, are expected to make provisions for whatever loans that start to show signal of there's a distress on the part of the borrower to service that particular obligation. Now that being the issue was what birthed the whole forbearance thing. And we started to see that this particular thing gave the banks leeway to gradually provision for these loans while meeting the borrowers to restructure or retenor these loans in order to make it easier for them to pay over a longer period of time. We had extended moratoriums. So now that they would have to exit it, the implications are, number one, if the banks haven't been previously providing for it actively, we may likely see provisioning go up. That's impairment charges go up. We may see cost of risk, that's a measure of that provisioning go up as well. But we notice that some banks have already come out to say, like you rightly said, that they'll be able to exit it by H1. We're talking the likes of Access, we're talking the likes of Zenith, we're also talking the likes of Fidelity that have clearly said H1 is the time when they'll be able to cater to, all this and address all that. So the implication is provision will go up. If there are still loans that are distressed, if there are still loans that are non-performing, we'll definitely see non-performing loans ratio for some of these banks go up as well. But if they've been actively taking provision that as they are meant to, based on what was initially planned in 2020, we should not see it, increase significantly. Like last year, for instance, and should I say the two consecutive years past, 23, 24, we did see that Zenith Bank maintained a particular cost of risk, which was 7.3, the highest amongst the tier 1 banks. That's the figures we're looking at it from that point of view. And it just speaks to the fact that they were probably already making preparations to exit CBN's forbearance. And that is why their cost of risk was that high. It means that they were trying to make sure they provision adequately for all the loans that fell under that category. So I believe other banks as well, that some of them do not have so much exposure to the banks. In fact, CBN did come out to say with a second press release saying that the number of banks that are, likely to fall under this category of exiting the forbearance and being unable to pay dividend are few. And the entire banking system is still or remains, sound. So all these things, I believe, will be the implications: the increase in provisioning, reclassification of the loans, the ones that are performing, the ones that are non-performing will, increase NPL ratios. But it's just for the short term, because for them to have already put a timeline to when they intend to rectify it, it means they have already been making plans for it.
So let's get to the reaction of the markets to this now. We saw that initial knee-jerk response, shareholders jumping, but for some other shareholders, they saw this as an opportunity to come into the market, and we saw some players yesterday, Zenith Bank, UBA, gaining above 5% here. Do you think we're going to be seeing a repricing of the banking stocks in the near term in the market?
Most definitely. Like I've described this particular scenario, it is short term. that they would, experience some level of pain in terms of profit and how they are unable to pay dividend. In fact, at the worst case scenario, what I would expect is that the interim dividend paying banks are the ones that may not necessarily pay in H1 2025, but they will be able to pay final dividends, that's for full year 2025. We should definitely see some repricing, because as these banks are coming out to clarify their current positions with regards to the CBN forbearance, it's giving investors that respite that, okay, the banks are actually aware that they would have to do this. And if you notice, most of the press releases always starts with the fact that they have successfully raised capital, or they have done XXX in terms of raising capital, which is one of the requirements that they would have to meet according to the CBN circular in order to make sure that they'll be able to resume paying dividends at the end of the day. So we should see some level of repricing. And this is just an opportunity for, as you mentioned, smart investors to buy the dip, as we like to say it in market parlance.
Finally, and very quickly, what does it mean for profitability within the sector for this financial year?
So for profitability, I would say in the short term, yes, it may be dampened slightly. It either would have a slower growth or a decline in growth. That's a decline in profits, if we're looking at it in the worst case scenario, because number one, we are well aware that this year we've had relative stability in FX. So they don't have that FX gains. It's just strictly business as usual. So if that is going to be the story, coupled with the fact that they would have to increase provisioning for banks that have not necessarily been doing so previously, it would definitely dampen profits, but it is in the short term. And given that most of them are saying they are going to exit the forbearance in H1, which is just 2 weeks away, because we're ending H1 in 2 weeks. So it means that it is short term that would definitely see profits being dampened. But in the long run, if they continue to remain very prudent in terms of credit administration and monitoring, then we should be able to see them improve their profit levels going forward.
All right, thank you so much for your time on the show. Banking sector analyst there from Chapel Hill Denham, Nabila Mohammed, talking about the exit from the banks on the forbearance by the Central Bank of Nigeria.